Welcome to our biannual sort of market update. And we call this one the State of the Markets if you haven't attended before, sort of as a play on the State of the Union. But we actually do this twice a year, usually once in February and once in August, and we call that one our mid-year market update. But really, it's just sort of we want to check in at least twice to give you some of the information that we're looking at. Now, what I'll say right up front is there's a lot of information that's going to be on the screen as I go through here, and I'm going to go through some of it pretty quickly, partially because things that look complicated are not necessarily always the most important things. Arguably, it's the simple things that are the most important, but I want everybody to know that if there is a point that I'm not dwelling on that's in there somewhere, and you're saying, "Oh, I wanted to learn a little bit more about that." We're open for questions. So if you look down in Zoom, if you're familiar with Zoom, there's a chat feature and then there's a Q&A feature. Everyone, you are in luck today because as I mentioned, we do this twice a year, and twice a year I go back deep into the back closet at we have at Stein Financial Group, and I pull out the old rusted shelf, and there's this cloth bag, and I dust off our crystal ball, and that's exactly what we're going to talk about today. Everything that's going to happen, 100%. Okay, no, I'm joking, obviously. What we're going to talk about today is where we think things might be going and where they definitely have been. That's the part I can be certain about. But I do have some things that you should all consider, even no matter where you are in the stage of life that you're at. Again, I'm Anthony Gerbi, part of Jeff Stein's group with Stein Financial Group. I've been doing this for about 10 years now. And one of my specialties is going through the markets and trying to come up with our strategy and what we need to watch out for. And honestly, what we don't need to watch out for sometimes. Maybe that's not the right way to put it, but things that might appear to be big issues, but actually when the chips fall aren't as big of issues. And we'll see in just a slide here kind of how last year was a good example of that. So I already mentioned questions. Again, there's a chat feature, there's a Q&A. You can also just raise your hand, which lets me know to potentially call on you. There will be time at the end. I'm going to make sure that we have time for questions because there's always a lot of questions about, well, where do you think we're going? We're in an election year this year, so I think that will be a topic we're going to cover. You'll notice, by the way, that as I get into this, there is not going to be any particular slide that talks about the election. I will talk about it a little bit in terms of what we're looking for, but that's sort of by design. This is designed to be more apolitical than not. I have some thoughts on the election that are apolitical, but kind of examining where different things could go. So we will get into that here. I know that's on a lot of people's minds these days. So without further ado, I'm going to get started here. My job is to be a translator here. I'm going to try to translate what's going on into A, language that people can understand, because a lot of times it's filled with jargon, but B, translate it into actual items or actions potentially we could take that will affect you and your life, not just the abstract, well, where's the market gonna go, excuse me. But how does that actually affect the decisions that I need to make on your behalf and decisions that you might be making in your life? So let's look backwards. How did the stock market do last year? Well, this is what's on the screen right now are the major banks in the United States, some of them anyway. Of course, there's a lot of banks, and their predictions for where the S&P 500 actually went last year. And this is where I want to highlight the first thing that if you're taking notes, I would just jot down or even, make a mental note of. But I want to call your attention to the term S&P 500. What does that mean? You might be familiar. It's on the news every night, the national news anyway. And what it is S&P stands for Standard and Poor's. And that's just the name of a company. They're actually a ratings agency. They rate companies as to how likely they are to pay back their debt, yada, yada, yada. What we care about is the S&P 500 is just a collection of the 500 largest companies in the US stock market, the largest stocks by number of shares outstanding times their stock price. And why I will continue to refer back to that, and why you'll hear many people continue to refer back to that, is it's sort of used as a bellwether for the entire stock market. obviously there are thousands of companies in the stock market, but the 500 largest ones, as they go, so goes the stock market in general. So goes the economy in a lot of cases. So that's why we use that as a shorthand. You may be more familiar with the Dow Jones Industrial Average, which is only 30 companies, but has also been used as a bellwether for many, many years. They measure slightly different things, obviously, but we would use them in the same way. So just think of it as the overall stock market, even though this is a subsection. I want to be clear about that if you've never heard that distinction before. So anyway, what I've got here is the predictions for where the S&P was going to end. And don't worry what that number refers to. That's not dollars, it's points. If you look at the stock market on a day-to-day basis, you'll see, oh, the S&P was at 5,000 earlier this year, which it was. That's just a point measure. Up is good, down is bad, same is same. That's all you really need to know about that. And the point of this is everybody thought last year was going to be kind of a mediocre to potentially even bad year. When we did this a year ago, I believe everybody except for Bank of America and Goldman Sachs thought the market was going to grow, but only by a tiny, tiny amount. And the Bank of America and Goldman Sachs actually thought it would lose last year. Well, it did not. It grew like crazy, especially at the end of the year. And we ended the year at 47.69. So you can see all these banks were way off in their predictions. And that was something that I had kind of been saying throughout last year. Not that I thought that they were, not that we had put our name down on, well, we think it's going to be 4,500 or 4,600. But I saw a lot of good news mixed in with some of the challenging news last year. And really, that's what it ended up being. There was a mixture of good and bad last year. And I think that is going to continue into this year. So we'll look at where they're projecting for this year. But last year, they were all way low. And I think we should remember that. And they can be wrong on the upside too. But we should remember that when we see, oh, I read the article online, ooh, bad news for stocks in 2024, or is a recession coming? All of these banks would have written a headline like that last year, and they were all wrong. So I'm not saying I'm better than them. We did see a little bit brighter silver lining last year, and that did turn out to be the case. But just remember when you read a headline that they might not know much better than the average person where it's going, even though they, in theory, should. So what happened last year? This is the second piece I wanted to point out. I'm going to go through these kind of key dates in a second here, but just look at the shape. So this is the market, the S&P 500, over 2023 as a calendar year. And obviously up is good, down is bad. And you can see the point numbers on the left there. So I want you to look at the shape of this and kind of make a mental note of that. I am starting to believe that this year could have a very similar shape to next year. That doesn't mean I'm saying, wow, I know there's going to be a peak in August and a trough in November, and we can really time that really well to take advantage of it. I don't know that. I'm not confident in the month-by-month timing of it. But the reason I'm starting to think that, first off, the year has started off very well, and we'll get to that in a second. This is last year, again, that's up on the screen. But secondly, we have an election this year, and I foresee some instability in the markets heading into that election. So call it the August, September, October timeframe. It would not shock me if those were down periods. Again, I'm not going to commit to a calendar prediction here, but a shape where we get kind of an early year bump, maybe a decline through part of the year, and then a rise. And that's the last part. And this is the part that I want you to remember. At least where we stand right now, this is what we're thinking. Probably after the election, and this is really regardless of the outcome, and that might sound weird, but I'll get into why we think regardless of the outcome, this could happen. But regardless of the outcome, we think there could be a pop in the markets after the election. Why do we think that? Well, there actually usually is. And we actually saw that in both 2020 and 2016, when obviously in 2016, it was Donald Trump being elected. 2020, it was President Biden being elected. And regardless of whether it's President Trump this year or President Biden, it seems like it's going to be one of those two. I know the primaries technically aren't over, but that's kind of where it looks like it's going anyway. Regardless of who it is, it's probably going to be a market jump. And one of the reasons, I'm not saying, wow, we're going to make 20% between November and the end of the year necessarily. But why I say that is the market likes certainty. And certainty is something you can never fully grasp, right? Nothing is ever for certain. But knowing who is going to be in the White House for the next 4 years, as well as what the dynamics of Congress are, which is an often overlooked thing when there's a presidential election, too, that will make a big difference to what the market believes will happen over the next 4 years. And that little bit extra certainty usually tends to be good for the market. Things tend to go up. Now, there's a million other things besides politics. I don't want to overemphasize politics, and arguably I should be underemphasizing it because politics only plays a minor role, but it does play a role. And so the reason I bring this up is I think this year could have a similar shape to next year. I would expect, for example, this year to have a 10% drop in the market at some point. And I say that partially because the statistics tell me that's going to happen. In about 63% of years, there's a 10% drop at some point throughout the year, right? But that doesn't mean the year ends negative. That happened last year and the year ended very positively. So watch out for that. We're going to watch out for it. But don't think that, oh my gosh, it's just going to keep going down. A 10% drop is normal. 63% of the time means it happens more often than it doesn't. And yet 70% of years are still positive at the end of the year. So what that should tell you is it's very common for a drop to happen. And then it's also very common for a recovery, even within the same year, to happen. And that's exactly what we saw last year with this picture. So a couple of key items. We had rate hikes at the beginning of the year, interest rates. That's what the rate that's being referred to is. And then we had inflation start to go down. And that was what led to this rally from March through August, at which point we started to think, ooh, I wonder if they are going to raise any more rates next year. And now the recovery from November has shown us that we actually think there's a decent chance they might cut rates this year, and they being the Federal Reserve. When I'm talking about rates, the Federal Reserve is who controls that. And I'll get into why that matters and how that might affect things. Actually, I have a very specific point to make on that, but that would be potentially good for the economy. Rates being cut means money can flow around a little bit easier. Mortgage rates might go down, for example. Yes, that might mean CDs at the bank are not quite paying as much. And I do anticipate that, by the way. So that would be one action item that I'll get to, is what to do about CDs or anything that you've done that's fixed, that you're getting a really good interest rate on now, but a year from now might not be nearly as good. We'll talk about that here at the end. But last year, the only thing I want you to take away from this page right here is we actually saw corporate earnings, which are not the end all be all, but one of the things that causes companies' values to go up is, are they earning more money or not, actually turn positive from sort of an end of 2022 lull into early 2023. This was part of the reason why these three little gray boxes on the right that are negative, that those banks thought last year was going to be poor. But we see actually positive earnings going forward, and that will be a good thing for the economy. By the way, it's very rare that you get these giant blue bars like we have from 21 to 22. The reason those are so large is because it was coming out of the pandemic, right? Everybody made a ton less money during the pandemic, and then they made a ton more relative to 1 year prior in the years after the pandemic. So that's why that's not normal for those to spike up that high. So we're not in the period like we were 16 to 19 in terms of where corporate earnings are, but we're better than we were a year ago. And that's something, considering last year was actually pretty good still. So here's what we actually had. And I'm not going to go through all of these numbers. You know, if you know what you're looking at, you'll be able to read it for yourself. But what I wanted to highlight here was the very top row, GDP growth. And this is another thing to keep straight in your head. So if you want to write it down, this would be a great thing to do it for. The economy versus the stock market. They are different. How are they different? What do I mean when I say the economy, and what do I mean when I say the stock market? Well, the easiest way is just to explain what the stock market isn't. Because what the stock market is just the collection of companies that we can all invest in. They're traded on an exchange, the New York Stock Exchange, the NASDAQ. That is just about corporations within America that, and there's stock markets around the world too, but corporations, whether they're earning money and what the value on one share of ownership is. That's what a stock price is. So does that affect all of us? Yes, it does, because we have investments that are invested in these companies. And so if their value goes up, our value of our accounts goes up. That's how the stock market works in a nutshell. It could go a lot deeper there. But the economy is much broader. The economy, in a way, is similar to the stock market because they move in the same direction, but it does not measure the same thing at all. What the economy, when we talk about the economy, or GDP, which stands for gross domestic product, which is, you've taken an econ class, you've probably learned about, but it's basically just a measure of what are we producing in this country and measuring that in dollars. We want to see it go up because that means our economy is growing. When our economy grows, we all have more money in our pockets to spend. We maybe are able to get a higher salary at work if we're still working. We are maybe able to our benefits, if we are retired, are all the more better funded because our economy is growing. There's a million things, but what the economy is it measures us. It measures what are we going out and spending, what are we earning, and if that continues to grow, in theory, life gets better for all of us. So we want that number to be positive. We all have more money to work with at the end of the day. That's a simplistic way to put it, but that's what it's measuring. And when you hear about a recession, this is the key of why I wanted to talk about this. A recession is a negative level of growth in the US economy. Now, you notice that all four of these numbers, quarter one, quarter two, quarter three, quarter four, that's just the four literally quarters of the year, first 3 months, second 3 months, third 3 months, fourth 3 months to get to 12 months. It's all positive. There were a lot of people who were predicting negatives last year, and they were wrong. And a lot of those banks that I showed you at the beginning predicted negatives in this column last year, and they were wrong. And these are actually pretty good numbers. Our economy actually grew pretty well, even though you might think 2%, that doesn't sound that good. That's sort of been our normal since about the 90s here. So seeing numbers in the 2% when a lot of people thought they might be negative is actually a pretty nice win. We anticipate similar levels of growth this year, which ultimately, as far as investments go, and as far as all of you, again, this is the translation piece, think of it in terms of, I don't think the economy is going to significantly weigh us down this year in terms of what you might make on your investments, or make any big differences into a plan that we may have put in place. Obviously, things are going to evolve, things are going to happen, but we anticipate a year somewhat like last year, actually, in terms of economic growth. And you can see inflation has come down and the employment rate has kind of fluctuated around about the same level. So please ask questions. Again, if I skip something on a slide, but I just have a lot of information to go through and I definitely want to leave time for questions. So where are we now? I want to take you back to November of 2020, which, if you remember, we're still in the middle of the pandemic here. I mean, this is pre-vaccines for COVID. I actually had COVID in November of 2020. We were all working from home, or at least I was, and we were still in the middle of it. This is where, and you can read all of these individually if you want, but what was our outlook? Was it positive in the green? Was it negative in the red? Or was it, well, it's kind of in the middle in the yellow? And you can see there's a fair amount of greens and there's a couple reds and then there's a bunch of yellows. And that's generally how an average time period would be. But if I fast forward, December of 2022, so that's just, 14 months ago, December of 22 now. So this is after the year 2022 we had, which was a really awful year for a lot of reasons. Both investment and sort of economic was not a great year either. And there were no greens, right? We were very concerned about monetary policy. That would be like the spending in our economy. We were very concerned about interest rates. They had just gone up an incredible amount. Very concerned about geopolitical risk. That one's been red for, I think, 5 years in a row now. So I think we're always going to be concerned about that going forward. But it was a little dicey. Some things were, over halfway. They were on the good side. Some things were on the bad side. Compare that to today, or at least end of January here. Things have gotten better, right? There's still no greens on this. So I'm not here to tell you that this is all roses and, there's nothing we're even concerned about. There's a lot of things we're watching. Internationally seems to be the place that it's really, concerning. We'll talk about that a little bit in terms of, there's been some headlines lately about Russia and China. And not that I want to be prisoner to headlines, but we'll talk about it a little bit here, at least in terms of what it might affect for us. But the good news is, yeah, we're kind of middle of the road here, but that's better than, again, going back a year or 14 months where a lot of these were in red. Things have gotten better. And again, a lot of people thought they were going to get worse last year. I think they're probably going to get even slightly better this year from where they are now. So again, I'm projecting forward here. I'm not going to spend too much time on this slide. This is leading indicators. This is sort of, if you were going to grab everything you possibly could that could potentially predict a recession and throw it into one chart and say, well, if the chart goes up, that's good. And if it goes down, that's bad. And we might see a recession. This is what you do. What I want to point out is, and by the way, these gray bars are recessions. So you can see 2008 is the fat gray bar in the middle. And then the obviously pandemic here is on the right. And that's why there was such a steep drop. But what I want to point out is on the very right-hand side, we've leveled off here. And this explains why some of those predictions were negative last year. There were reasons for that. I'm not trying to say that these people were crazy and that they were just had their head in the sand. There were reasons to be pessimistic last year. They just didn't actually come through because the market was more mixed. And I do foresee this going in the right direction going forward. So I don't want to spend too much time on that because that's a very technical piece of information. So what are we watching here? We're watching more than what's just on this screen because, again, the election is another thing we're watching here. But headwinds would be things that blow against us, right? What could slow us down this year? What am I, somebody like me, tuning into every day and really listening for? Well, number one and number two are tied together: inflation and Fed policy. Okay, so we continue to need inflation to come down. It has been coming down, but it's running around 3% right now. And long term, we want it closer to 2%. What does that mean? Well, if we see inflation continue to come down, that will give the Federal Reserve the ammo they need to be able to say, we think we might be able to start cutting interest rates, because they don't want to overdo it. They don't want to get inflation down to zero per se, because that could be bad for unemployment and other things. I won't go into all that right now, but that's a relationship that exists. Inflation and unemployment kind of work teeter-totter to each other. So we're watching that very closely. We actually think there's a decent chance interest rates do come down, but if inflation stays high, they probably don't. And that's a potential headwind for the market and for all of us. Again, this goes back to if you've got CDs right now, potentially if rates come down, you might not be able to renew those for the same level of rates that you got when you took them out this past year, for example. That means we need to think about a different option. At the very least, you need to shop around, and we can help you with that. Corporate earnings, we talked about that a little bit. If corporate earnings are down, that would hurt the stock market, and that would make our investments, whether they go down or whether they just don't go up as much, either way, that would be a headwind, but that's another thing we're watching. New competition, that a lot of people are keying into the global world as competing with US manufacturers in different ways. But even within the US, how do we continue to ensure that in our country and the companies that we're invested in are competing at the highest level, right? Are not being overtaken by companies elsewhere that we're not invested in, so we don't get any benefit from it. That's always a challenge. That's a challenge every year, regardless of the environment. Will there be a recession this year or not? Okay, let's talk about it. Will there be a recession next year? I couldn't tell you that I know for sure. I do not believe so. And let's talk about what a recession is, by the way, because that'll help you understand why I don't think so. So this would be a thing to write down again. A recession, traditionally defined, if you look up an old economics textbook, of which I still have some from my college days, it will tell you that a recession is 2 quarters in a row, which really just means 6 months, of negative economic growth. Negative economic growth. Okay, not negative stock market growth, right? The stock market can be down and we can be in a great economy still. That doesn't mean we're in a recession when the market goes down. So when you see potentially investments go down over some period, that doesn't mean we're in a recession. What happens in a recession is our economy actually shrinks. We make less money as a country than we did a year before, for example. And that has to happen for 6 straight months to have a recession by the classical definition. Now, I reference classical definition because a couple of years ago in 2022, we actually had 6 months of negative economic growth and they didn't call it a recession. Why not? Really, I mean, if you're going to read between the lines, it's political. The federal government has decided that, well, we're going to use some other criteria as well to determine whether it's a recession, and it's sort of up to the National Bureau of Economic Research to decide that. Fine. If that's the way they want to do it, fine. I'm going to go by the old definition. So according to me, we had a recession in 2022. Now it was very short. It was only 6 months. And the market was down because it was down in 2022, but it was sort of down for different reasons than the economy wasn't doing well. But are we going to have one this year? Again, I don't think so. And one of the reasons I don't think so is if we were going to have one this year, remember, we only know we're in a recession by looking backwards over the last 6 months. If one's going to start in the second half of this year, it basically has to already have started. And that just doesn't seem to be the indication we're getting from the data. So that's why I feel at least willing to be able to say, I don't think there's going to be a economic recession this year. Again, markets are going to go up and down. I'm pretty certain of that. But I don't think there's actually going to be a recession. Now, I could be wrong. And if anybody was able to predict these with 100% certainty, I'd be able to get a very fancy job, probably right next to the White House, and just walk into that office and say, yep, April 30th is when it starts, and let's all prepare. But nobody has that power. So we're just going off of what we know today. But I just wanted to, that's a common question we get, I guess. And then geopolitical tension. So let's talk for a minute about specifically China and Russia, because there's been a couple of different things in the headlines lately. I anticipate we might get a couple questions about this towards the end anyway, so let me just address it head on. Number one, we are still in a great position in this country, economically speaking. Our stock market is doing incredibly well versus the rest of the world. In fact, you read a bunch of articles right now how most of the major other countries, that was a very generic way to put it, many other rich nations around the world have slipped into recession right now, actually. The UK, Japan, I'd have to look at France, but I think they're very close if they're not in one right now. The European Union as a whole is sort of stagnant. And why is that happening? And the US's economy is doing pretty okay. And relative to everybody else, we're doing great. Part of the reason for that is because of how we responded to the pandemic. We did pump our economy with money. And I know that you're probably saying, well, didn't that have some consequences, Anthony? It did. It did. And I'm not trying to minimize those. Inflation was largely caused by our response to the pandemic. But if you look at the results, and I guess the proof is in the pudding, our economy is doing a lot better than the other countries who maybe didn't pump as much money in there. And every country had a different response, and I'm not trying to lump them all into one group. But there are a lot of articles out there right now about why is the US doing so much better than everywhere else? I don't think it's because we're just flat out better. I think it's because our response to the pandemic was a little bit better. But specifically with China and Russia, we are in a position where we don't see, and of course you could argue, well, you're not going to see it until it happens, Anthony, but we don't see any imminent, threats in terms of our economy or our way of life necessarily. There's always going to be tension. These headlines have been about space and putting new satellites in space. And, I'm no national security expert, so I'm already at the end of my rope here. But what I'll say is it's in the rest of the world's interest still at this point to have the US be a strong power. Now, I'm not saying they're not trying to grow and nip at our heels here, but it is in the interest of the rest of the world. China, for example, with this, there's been some cybersecurity headlines, which I anticipate will keep happening. But we are one of, if not their largest trading partner. It does not make sense for China to try to significantly undermine the economic power of the United States. It makes sense for them to grow their own, don't get me wrong, but they're collecting money from us. We're trading with them. So that there will be tension, don't get me wrong. And this will not just be all, roses here going forward, but everybody has an interest. People ask me this in terms of the debt, and I'm sure we're going to get a question on the debt. If nobody asks it, I know you're thinking it, because I get one every year during this presentation. And they say, well, doesn't China own so much of our debt? And, is China going to end up owning this country? That's not really how that works. It's not like owning a business where it just transfers ownership. Nobody owns the United States per se. Again, that we could talk about that, but China's interest in buying our debt, which is what they're doing, is because they view us as stable, is because they want our long-term success. The only way they get paid back is if we're long-term successful. I'm not saying China's our best friend next door and we just haven't realized it yet. They've definitely worked against us in many ways, as have other countries. But that's a very common question I get, and I wanted to just illustrate that relationship a little bit. By buying our debt, they are incentivized to have our economy continue to produce because that's how they get paid back on that debt. So, enough said. I've probably already gone too far down that rabbit hole, but I know people are thinking of it because we get questions on it every year. All right. What's going to potentially work in our favor this year? Okay. What's working in our way? Well, moderating inflation. Inflation that's going down to the level we wanted at, that would be great. That would potentially give us the ability for the Fed to be quote unquote dovish. And think back to your high school social studies, dovish versus hawkish. Hawkish is aggressive. They want to raise rates. Dovish is they want to cut rates potentially. They're kind of peaceful. They're dovish. That's what we could see this year. And that would actually be a benefit to our economy and potentially the markets too. A China stabilization. Your guess is as good as mine. China is sort of this black box a lot of the times. But a lot of what this next election is going to be about is what is our relationship with China going to be? And they are one of our largest trading partners. So it is important for us to try to build a good relationship with them. I'm not going to say that that's easy. I'm not going to say that that's going to happen for sure, but it would help a lot if it did, I guess is the point I'm making. Higher corporate profits. Maybe we're going to have a very good year. In fact, I think it's, again, going to be on the better side of good, but we'll see where it ends up. But that would be a good thing. That would potentially lead the market to go up more. And then artificial intelligence. And this is just a big wild card. That was the big trend last year. A lot of these companies, chip manufacturers, the big tech companies that have invested in AI. I'm not here to tell you that there's, a particular stock that I'm really looking at. Are we all going to be, am I going to be doing this presentation next year with one of those Apple Vision Pros on my head? Maybe, maybe not. I don't know if that's going to catch on, to the mass market by this time next year, but things are going to continue to evolve. And if we can turn that power into productivity, we as a society, that's going to be a good thing for our economy overall. There are a lot of pitfalls there. I'm not saying it's all good, but there could be a lot of good that comes from that, and that would be a potential tailwind, meaning a good thing. So I'll go quickly through this. Don't worry about the numbers on the screen unless you're already familiar with how this works. But basically what this is based on those purple lines, is the stock market expensive right now, or is it cheap relative to its historical average? And this goes all the way back to the 90s. You see the dot-com bubble on the left there. And then you see 2020, the big run up after the pandemic on the right. Those are kind of the two peaks you see. And where we're at right now after 2022 is we're on the slightly above average in terms of expensiveness side, but we're not off the charts. And I think that's a key point for one reason. What you don't want to do when you invest money is buy high and sell low, right? You want to do the opposite. You want to buy low and sell high. Well, it's tough to buy low because buying low usually means buying in at the exact scariest point at which you can buy in. But what I'll tell you, and there's not a chart on this slideshow that represents this. You can actually look this up online yourself, but they've done studies going back over this exact time period that I've got up on the screen. And they say, what does the stock market average over the last 20 years? And what does the average investor average over the last 20 years? And this is what I want you to write down if you've got a notepad handy. Over the last 20 years, the stock market has averaged between 9 and 10% per year on average. Now, that includes years like 2022 where things dropped. That includes 2008 where things dropped significantly. But it also includes the years where it recovered, right? So it's between 9 and 10%. What do you think the average investor has made over that same time period? Again, stock market 9 or 10%. Maybe the average investor doesn't have all stock, so you could discount it for that. Just think of a number in your head uh, for what the average investor has made. The average investor in that same period has made 2.5% a year on average. 2.5% per year. That's barely enough to keep up with inflation. I mean, you're basically treading water with inflation there, which means you haven't really made any money at all, because inflation, the cost of things going up and down, has eaten into your spending power. Why is that the case? Why hasn't the average person? Well, there's many reasons. One is not everybody's all in the stock market, so that discounted a little bit from there. But even somebody who's only 60% in the market, 40% out, if they had stuck with it the whole way, would have made about 6-7% a year. The reason why people have only made on average 2.5% is because they get in and they get out at the wrong times. They buy high and they sell low. When things look, hey, the sun has come out, last year ended really good, now's the time to get in, right? Well, it might be, but the time to get out is not when it drops, unless there's some real big reason. And this is what I'd say to all of you, and this is going to be true for the people who work with us, as well as people who you're maybe still in your work retirement plan, whether you're still working or not. We need to get you into a place where we can weather markets going up and markets going down and not have to get out. Because that statistic that I just quoted you shows you why it is so dangerous to get in and get out. You can really hurt yourself over the long term. Here's another quick fact for you. If you, over a 20-year period, genuinely over a 20-year period, if you miss the 10 best days in the market, you cut your average return for that entire 20 years in half. Just 10 days out of 20 years. That is an incredible amount of loss to sustain for just missing a week and a half, right, of the best days. By the way, when do the best days happen? Usually right after the worst days. So that's why it pays to stay in. So for anybody who does work with us, if you have your account with Stein Financial Group, we're already taking that into account. We're trying to put you into a position where no matter what happens, within reason, we can ride it out and get to those best days after, yes, maybe weathering through some of the worst ones. If you don't have your account with us, if it's still with Voya in deferred comp, for example, that's something you should be talking with someone about. You can talk to us about that. We can help you manage your account. So, Aaron, at some point, if you could throw in the link to set up an appointment with us to talk about it, you can click that when Aaron puts it in the chat, and you can meet with us and we can look over your account. So if you already work with us, we're doing this already. But if you don't, and I know the reason I'm saying this is there are people on here who don't, you need to talk with somebody, because where we are in the market, whether it's overpriced or underpriced, really determines how risky you might want to be, as well as your retirement timeline. Are you recently retired? Are you about to retire? Well, I'm not doing a retirement presentation. We're talking about the markets, but this is where it really impacts your life. So I saw Aaron just put the link in the chat. If you haven't, set up a time with us, especially if you haven't talked to us. Again, anybody who works with us, we're already on top of this. Certainly, we can meet whenever we want. But anybody who doesn't currently work with us, I really encourage you to do that. So what are our forecasts here? I've kind of been forecasting as we've gone through, and I won't go through all the technical details here in excruciating detail, even though I could. And anybody who knows me knows this is kind of my bread and butter. But what this chart is showing is earnings per share. That's EPS. And basically, if it goes up, that means companies are earning more money, and therefore we might expect their stock price to go up, or therefore the market to go up. So earnings per share going up, good thing. Our projections for this year, you can see them in the kind of shaded green or different blue, I guess, to the right. Q1 24, Q2 24, Q3 24, Q4 24. It's kind of going up and to the right. That's where we want it to go. That's another reason why we anticipate this year will be a good year. This has to do with interest rates. Don't worry about the numbers. What I want to tell you is we feel very strongly, and have felt for a while, that one of two different things is going to happen this year in terms of interest rates. They are either going to stay the same or they are going to go down. They are probably, and not that they can't, but just the indicators don't seem to point this direction. They're probably not going to go up. And if you're If you're a logician sitting there, there's only three different options for interest rates. They can go up, they can stay the same, or go down. That's the only three things they can do. We feel pretty confidently they will not go up, which means it's going to be one of the other two. This leads to one specific piece of advice I have, really for most anybody. I mean, I can't say it's for everybody because everybody's a little bit different. But one of the quote unquote trades of the year that we are really looking at for everybody we work with, and again, if you don't work with, this would be something that I potentially would help you advise you on whether to do or not, is bonds do well when interest rates go down, and they tend to do just fine when interest rates stay the same. Now, they don't do well when interest rates go up. That's what happened in 2022. That's why bonds didn't do well. But they do pretty well in the other two scenarios. This could be a year where you could add to your bonds and actually benefit significantly from interest rates going down. And that has been a move we have made with many, if not most, of the people we actually work on accounts for. So many of you on this call have already had this taken place. We've kind of already put it in motion to do this. We're proactively doing it. But for those of you who don't work directly with us, you probably haven't had anyone do this. And that's why it's really important to talk to somebody, because if interest rates stay the same or go down, bonds are going to do potentially better than they've done in, possibly the last 5 years. No, we don't know what's going to happen. I'm not going to say, wow, I know exactly what bonds are going to do, but that is the big opportunity this year. So we are prepping for that with the people we work with. And I think if I was going to highlight one quote unquote trade of the year, I think bonds that can take advantage of interest rates going down are a great place. It takes risk off the table from the stock market, and it potentially gives you a pretty nice return too. So that's a move we're already proactively making. But again, I would encourage anybody to think, if you do it yourself, great. Think about how that might be a fit, or talk to me about it, because I can help kind of parse that for you. So these are projections. I'll make myself a little smaller here for this coming year, for where our economy is going to go, gross domestic product. And you can see previous versus new. Let's look at real GDP here. Real GDP is just after inflation has been taken out. So that's the only thing that real means. We are anticipating positive growth, but maybe just slightly positive, right? We're talking like around 1% instead of around 2%. I feel like this might even be a little low. I think we might actually end up closer to 2%. But what this is showing you right here, since all of these numbers are positive, we are not anticipating a recession for this year, right? These are actual projections done by a third party. So this isn't me typing in the numbers that I think. Again, I think they might be a little low. But this is a third party doing this. The Philadelphia Federal Reserve Bank, by the way, is the one who put these numbers together. Not that they're, better than necessarily anybody else, but they do have access to all the data at least. And they don't think there's going to be a recession this year. I'll take it. We might have a slight increase in unemployment, but it would be very slight. We're talking 1/3%. So not that that's necessarily good, but in terms of getting inflation down, again, those two things usually work teeter-totter to each other. That's what we kind of expect to see. So this is good. This is pointing in the right direction for us. Jobs markets. One of the things that's happened in the last couple of years, and I won't spend too much time on this, is we, after the pandemic, increased our savings in this country by an astronomical amount. Now, part of that was part of the stimulus that was handed out and all sorts of different relief measures coming from the pandemic. That's partially why we had inflation. But look at what's happened to that savings. It's really dwindled as we've spent a lot of this money, and it's gotten back to quote unquote normal rates. Now, I'm not saying it's a bad thing to have money in your pocket. That's really been helpful for a lot of people. But ultimately, our economy is about earning money, spending money, saving money too. Obviously, that's what I work with every day. So I'm pro saving money. But we don't need to have, as a country, $2.1 trillion doing nothing, sitting in a bank somewhere earning, 0.5% if you're lucky in interest. That money could be invested better elsewhere to actually help grow the economy or invest in the companies that are growing the economy. And I've seen it personally with people saying, hey, we're sitting on a ton of cash right now, Anthony. What should we do with it? Well, getting it invested is probably a good baseline to work with, and we can even keep it pretty safe. It doesn't have to be, super risky, but it's probably better than leaving it in your bank account. So if that's you and you're saying that, hey, we actually do have a lot in savings, and I don't know if we need that much, then talk to me about it, because there are options, even completely guaranteed, so you don't have to put it at risk, that could potentially get you more than a savings account. And again, when CDs start coming due this year, if rates go down, that's going to be a conversation we're going to want to have too. So we're back to where we started. We've come full circle. Where are the big major banks predicting our stock market to go by the end of the year? These are their end of the year predictions. All right. So a couple of the more optimistic ones are saying 5,100 by the end of the year. Then we had a couple 5,000s. Remember, we ended at about 4,780. So that would be growth that almost everybody's predicting, except JP Morgan and Morgan Stanley. They're predicting negative years. Now, they predicted negative years last year, remember, and they were wrong. But, there's a spread here. There's a spread. So I'm not saying it's all sunshine and roses. I tend to be in the Deutsche and Goldman Sachs sort of camp personally. But I'm not JP Morgan, Morgan Stanley, no dummies. We actually invest in some of their funds. So I trust to an extent what they say, or I at least believe that they have conviction behind what they say and good reason behind it. But I will say I'm positive. And one reason I'm positive, we actually crossed 5,000 earlier this year, just a couple weeks ago. Now, last week and into today, the market's dropped a little bit. So we're in the 4,800s again, I believe. But we're actually above today where this end of the year group average is. Now that obviously we've got a lot of year left, things could drop from here. So I'm not saying that means that they're wrong, but I do believe things will end up being better than what at least Morgan Stanley and JP Morgan are tending to think here. And I think it will be mixed, but I do think it will be better. So these are some stats that I could have quoted back when I was giving you those average investor stats, but I knew I had a slide for it, so I waited. This is the value of discipline. So in the S&P 500, and very few people on this call should be all in the stock market. That's for people who are very aggressive. But just so you see, over a 10-year period, there is only a 6% chance, historically speaking, that an investment all in the stock market would be down for 10 years. Now, you might say, I can't afford the risk of being down for 10 years, Anthony. That's crazy. Even at a 6% risk. Totally fair. That's why we don't want you to be all in the stock market. That takes a lot of that risk off the table even more. But just so you know, 70%, 73% of the time in any given year, the market is positive. So I hear the market described as a casino a lot, and I get why. There's a risk, right? It can go up and it could go down. But if I was at a casino and I knew there was a slot machine that paid out at 73% of the time, that's the one I'd be sitting at all the time, right? So it's not quite like a casino in that the odds aren't in your favor. They are in your favor. Over a 3-year period, only 15% of only 16% of the time, only 15 times over this time period that we're analyzing here, was the market down over 3 years. That's pretty good. By the way, the market's only ever gone down actually 3 years in a row once, and that was 2000, 2001, and 2002. Not even during 2008 did it go down 3 years in a row. A 5-year period, even better. I think the rest is kind of self-explanatory. This is why it's important to stick with it. The longer you stick with it, the more likely you are to end up with a positive result, that you've made money. I know I've said that a million different ways already, but things that I need from you, okay? This is what I want you to think about. Keep us informed of your life changes. Please keep us informed. If something changes with you, that might mean something needs to change with your investments. We can help with that. That's our job. But we can't do it unless we know that something's changed with you. Tell us about your concerns. I'm going to open it up for questions in just a minute here. And so please tell us about your concerns so that we can make sure that they're being addressed. If you feel like, I'm really just not risky, Anthony, are you sure my account's set up for that? Let's make sure. Our job is to do that from the get-go, so I feel confident about it. But I want to evolve as you evolve too. And make sure your essential documents are up to date. If you haven't done a will, let's say in the last 10 years, I think a lot of law firms will tell you 5. 5's probably a good number, but especially in like 10, especially if you've had a major life change, move to a new state, for example, is one that people overlook. It's probably time to get a will refresher done. That among other things, but make sure your documents are up to date. By the way, A month from now, we're going to be doing a follow-up to last year's very popular What If I Die workshop, which is where we kind of go through a lot of those essential documents. You'll all be getting invites for that shortly. We're just about to send those out. But please tune in for that, or stay tuned for that, because that will have a lot of great information on specifically that topic. And then for me, I want to keep you informed. That's why we're going to continue to do these monthly events. We're also just available. If you have questions, please get in touch. We're going to continue to proactively make changes as we can and talk with you about those changes that we might want to make to get your accounts to do the absolute best for you that they can. And just like I'm presenting today, it's my job to stay on top of what's happening in the world. So, and in our country specifically, so that we can be ahead of the curve as much as possible anyway. So that's my content for today. Anybody have any questions?
I'm curious about, I read an article about Bloomberg. Oh, can you hear me?
Yes, I can. Yep.
Okay. And it was an opinion article that was based on the 401k. The title was Will Be Gone Within a Decade. That's by Allison Schrager. Curious about that. I mean, is that part of the reason that Stein is, I don't know if you've completely become a different entity from Voya, or if Voya is handling the paperwork, but and it's just based upon the fact that the government is really looking at the trillions of dollars that the baby boomers have socked away in their accounts, and feeling that the 401k is not maybe the best vehicle for people going forward as far as savings go.
Yeah, no, great question. I had not seen that article. I just pulled it up to look at it, at least the quick synopsis of it, and I see what she's getting at here. In general, I disagree with her opinion, but I see what point she's trying to make. So before I even get to that, let me go back, because you mentioned the Voya piece of this. So a lot of people maybe know this on the call, but just bear with me as I go through it. Our group, Jeff's group, was with Voya, and before that ING or ING, and even before that Aetna for decades prior. And we worked with benefits for Hennepin County and a lot of the other public municipalities around the area. But we were part of a sale. Voya sold part of their business back in 2021. And all that means, I could go through the details, but that would probably bore you. All that really means for people who are still with Voya is we can't see your accounts live anymore like we used to. So we used to be sort of the advisors on that case, where we'd help you make decisions about your allocations and rebalancing and taking money out and all that stuff. We are not that anymore, because we're not with Voya anymore. Voya sold part of their business. So we still absolutely work with everybody like that. And we encourage you to meet with us, because we know we haven't been there to meet with you for the last couple of years. But we're doing it as Stein Financial Group now, because we're not with Voya. So what all that means is, when you set up an appointment, bring your statement so that we can take a look at it. I'm still very familiar with all of the options the county has available, all of their funds, the rules, the fixed account, and what that's doing, which is, as of lately, kind of not much. So if you have a lot of the fixed account, that's a place to do it. But that's the cliff notes on, we're not with Voya anymore. A lot of people still think we are. So if you wanted to meet with us, Lori, or anybody, you set up a time, we talk just like we did before, but I can't see your account live to make automatic changes anymore, is sort of the gist of it. So that's the cliff notes on Voya. Let me get back to then your question about 401ks. So I see the article. My read on just the synopsis, obviously I haven't read every word of it, is based on the government's revenue needs, they may want to look at whether 401ks or 403bs or 457s, any pre-tax retirement account, whether that should be allowed to continue purely off of those taxes aren't being collected when you save that money. They're only being collected when you withdraw it later in life. So it would be a way to sort of increase taxes by taking away the option to do that. That would be a tough pill to swallow, I think, for a lot of people. Now, just so you know, not even in this article is this person saying that your account that you already have would go away. That would stay. So there's no question that any dollar you've saved will not go away by federal mandate. They're not just going to wipe that away and say, well, you're screwed. You saved, but we're taking it all right now. They won't do that. I can't say they couldn't do that, but oh my gosh, that would be pandemonium if they
Revolution.
tried to do that. So I don't think that's going to happen for sure. But will there be tweaks to the law? Will contribution limits come down? It's possible. I will say just over the past couple of years, they've raised the amount you're able to contribute to those accounts. So they're kind of working against that thesis in the short term, but I couldn't say never. But for the foreseeable future, I think if the federal government could do anything, they'd probably get people to save more into those accounts right now, even though it's less revenue for them up front. Because the problem is they want people to not be as dependent on Social Security as they are right now. And a 401k is kind of the best hedge against that. So they kind of want to incentivize people to do it, would be my take.
Yeah, it just popped up.
Perfect.
You, either I spaced out or you didn't talk a lot about consumer confidence.
There was
And
one. Yeah, go ahead.
there was one spot that you did,
Yep.
but consumer confidence and actual economic performance doesn't seem to correlate all that much. And if consumer confidence were more more correlated with the reality of how well the economy's doing, because as you said, it's doing pretty well. Wouldn't that have an effect on the market and on what people are buying, and how does that word get out, and how political is that? I just like to know a little bit more of your viewpoint of what that all means.
Yeah, absolutely. So what Art's referring to, and I pulled up the slide that referenced it. What this is it's a number from 1 to 100 of where a poll is done by the University of Michigan. And this is considered sort of the best standard for judging where all of our heads are at, basically. Do we think good things are coming, or do we think bad things are coming? The closer you are to 100, the better the sentiment is. The closer you are to 0, the worse the sentiment is. So if everybody was super pessimistic, it would be down towards 0. If everybody was happy-go-lucky, optimistic, it would be up at 100. And you can see we're kind of treading water here. We're in the 60s, so I guess that's good. But it's not like everybody's all sunshine and roses. And usually, this is taken, I shouldn't say usually, it is taken very seriously by economists, because as our moods go, so goes the economy, right? If you're pessimistic, if we are all pessimistic about where the economy is going, where our personal finances are going, we're less likely to go out there and spend money, potentially, right? That's historically what it's been. What I'll tie this into is if you were reading any major news publication in the last year, you probably saw an article talking about doom spending, right? That was kind of a trendy buzzword from last year. And that is talking about specifically this phenomenon where the spending numbers, the productivity was actually pretty good, but the sentiment was bad, or not bad, but at least mediocre, right? And why is that happening? Usually those two things move in lockstep, but there seems to be this disjointed. I think a big portion of why sentiment was more poor than the actual results came in last year was specifically because of there was a lot of mixed news out there, but I think the news that was making the big headlines was the negative side of the equation. So I'm not trying to make a case that we're all, sheep being led by the media or anything into believing something that's not true. But I think if you focus on the negatives, which as humans, that's kind of what we tend to do, it leads to a much sourer, a more sour, I guess, picture of what was actually happening than the reality, which was more mixed. And I think over the last 12 months, through the events that I've done, I've been making that point that, hey, just because you see an article where it's like, hey, we're headed into a recession, things are looking bad, that's one opinion based on some facts and some prognostications, but there's another opinion available, which is things are looking better than what people thought. So I think the difference where that consumer sentiment is versus where the results ended up was specifically because there were negative things to focus on, but they were focused on too much by the general public, and especially, I think, the media, because that's what sold clicks. I mean, let's be real. You see an article about doom spending, that's going to sell a lot more ad clicks than it is for an article about, hey, I think we're doing okay. You know, that's not really a sexy article title. Those articles are actually coming out now, which is kind of nice. That really gives me a more confidence. But I think that was the big thing. I think everybody came into last year saying, ooh, things aren't going well. The economy's not doing well. And then it did just fine. And everybody was kind of like, oh, well, that wasn't so bad. You know, even though there were ups and downs through the year. So there's no perfect answer, but that's what I saw last year. People talking about doom spending while the economy's going down and everybody's just spending money anyway. Maybe they were just spending money because the economy was doing what it does. You know, I think that's really the real headline, but that's not going to sell as many clicks, I guess. But I thank you so much for your time. I hope this was valuable. I hope you got something out of it. And again, we're available for questions, concerns, meetings, whatever you need. That's what we're here for. So with nothing else, I will see you all next month for our What If I Die workshop, which will be more fun than that title maybe alludes to. Take care, everybody.